Welcome back to the Pro Ticker Podcast, your Tuesday morning edition, covering major financial magazine headlines, everyone. Today we're diving into some pretty interesting stuff.
Yeah.
How companies are using your investment dollars.
Right.
And what's happening with the global economy.
Uh-huh.
Think of it like connecting the dots between your portfolio and the world at large.
I like that analogy.
Yeah.
Yeah, we're going to look beyond simple stock prices
Okay.
and decode what's really happening behind the scenes.
And we've got a stack of articles
Okay.
from MarketWatch, The Wall Street Journal, Bloomberg, and CNBC
Great.
to guide us.
Sounds good.
Okay, let's start with this MarketWatch piece
All right.
about return on invested capital, or ROIC.
Yeah.
It highlights 10 S&P 500 companies that are really making the most of investor money.
ROIC is a crucial metric.
Yeah.
It tells you how efficiently a company is using its capital to generate profits.
Right.
Imagine you put $1 into a business.
Right.
How much profit does that dollar produce? That's essentially what ROIC measures.
The article dives into a company called VeriSign.
Okay.
And it seems like standard accounting can be a bit tricky.
Uh-huh.
They had this huge ROIC initially, but then...
Right. VeriSign's reported ROIC was over 200%.
Wow.
Which sounds phenomenal,
Yeah.
but the article explains that this figure is skewed
Okay.
because of past write-downs.
I see.
When New Constructs, a research firm, adjusted the ROIC to account for these accounting quirks, the number dropped significantly closer to 4%.
Oh, wow.
It's a good reminder that we need to look beyond the surface numbers sometimes.
So who are the real ROIC superstars?
Yeah.
The article names 10 companies with impressive adjusted ROIC numbers.
The top 10, according to New Constructs,
That's
are
right.
Texas Pacific Land,
Okay.
Arista Networks,
Mm.
NBR,
Got it.
Apple,
Uh-huh.
MasterCard,
Yeah.
NVIDIA,
Mm-hmm.
Booking Holdings,
Okay.
Vertex Pharmaceuticals,
All right.
Moderna, and Enphase Energy.
Wow. Quite a mix of companies there.
Yeah.
What makes their ROIC so high?
Well, each company has unique factors
Yeah.
driving its ROIC.
Can we break it down?
Absolutely.
Right.
Take Texas Pacific Land, for example.
Okay.
Their business model is remarkably simple.
Right.
They own vast amounts of land in Texas, rich in oil and gas, and they lease it out to energy companies.
Okay.
Low overhead and high demand result in a soaring ROIC.
Interesting. So it's not always about complex technology
Yeah.
or cutting-edge innovation.
Exactly.
Sometimes it's about owning valuable assets
Yeah.
in the right place at the right time.
Precisely. Now, on the other end of the spectrum, you have a company like Apple.
Okay.
Their high ROIC is driven by their brand loyalty, innovative products, and ability to command premium prices.
Yeah.
They also have incredibly efficient supply chains, which keeps costs down and profits up.
Okay. That makes sense. It seems like understanding a company's business model is key to understanding its ROIC.
It is.
But how does all this tie into the global economic picture?
Right.
Our other sources paint an interesting picture of what's happening in Europe and Asia.
Indeed. We have articles from the Wall Street Journal and Bloomberg
Okay.
highlighting Europe's ongoing battle with inflation.
Uh-huh.
At the same time, Bloomberg also reports on the surprising comeback of China's junk bond market.
Interesting.
These seemingly separate events are actually interconnected in the global financial web.
Okay. I'm all ears. Help me connect the dots here.
Sure.
Why should we care about European inflation or Chinese junk bonds?
Think of it this way.
Okay.
European inflation can impact U.S. interest rates and global trade.
Okay.
A surge in prices over there can ripple across the pond and affect prices here.
I see.
And China's junk bond market, as risky as it sounds, can actually signal investor sentiment and potential investment opportunities.
Okay.
If investors are willing to take on more risk in China, it might suggest they're feeling optimistic about the global economy.
So even if we don't directly invest in European or Chinese markets, these trends can still impact our portfolios here in the U.S.
Absolutely. It's a reminder that the financial world is interconnected.
Yeah.
What happens in one corner of the globe can have ripple effects across the board.
Speaking of ripple effects, CNBC has an article about the UK's 30-year bond yield hitting a 27-year high.
Wow.
I have to admit I don't fully grasp the the significance of that?
Sure.
Can you break it down for me and for our listeners?
Of course, bond yields and investor confidence have an interesting relationship. In simple terms, when a bond's yield goes up, it generally means investors are demanding a higher return for lending money.
Okay.
This often happens when investors are concerned about risk.
Right.
In this case, risk associated with the UK's economic future.
So this record high yield suggests some investors are feeling a bit shaky about the UK's long-term economic prospects.
It seems that way.
What factors are contributing to that uncertainty?
There are a few potential culprits.
Okay.
The article mentions the government's substantial borrowing plans, which could lead to inflation and weaken the pound.
I see.
There's also the possibility of slower economic growth in the UK,
Right.
which could impact investors' returns.
Okay. I'm starting to see the bigger picture here. But even if I don't invest in UK bonds, how could this trend affect me?
It's all about those ripple effects we talked about.
Okay.
Rising UK bond yields can influence currency exchange rates, making it more expensive to travel to the UK or buy British goods.
Right.
It can also impact interest rates in other countries as central banks adjust their policies in response to global trends.
Ooh, okay.
And of course, it can influence overall investor sentiment,
Yeah.
which can affect markets around the world.
Wow, that's a lot to unpack.
Yeah.
So we've got these companies with impressive ROIC.
Right.
But then we have these global economic trends that could throw a wrench in the works.
It's true.
It's like a constant push and pull.
That's a great way to put it. It's a dynamic system.
Yeah.
And understanding both sides of the equation is key to navigating the financial landscape.
Right. Before we move on to other themes,
Okay.
let's circle back to that MarketWatch article for a second.
Sure.
It mentioned that Warren Buffett's Berkshire Hathaway holds a large stake in VeriSign, despite the adjusted ROIC numbers we discussed earlier.
That's right. It seems Buffett sees something in VeriSign that goes beyond the standard ROIC calculation.
It's interesting that Buffett, a renowned value investor, would be attracted to a company with a seemingly less impressive ROIC.
Yeah.
I'm curious to know what he sees. Is it a classic value play?
It could certainly be partially a value play.
Okay.
But the MarketWatch article also highlighted VeriSign's high profit margins. That's something Buffett has always emphasized. High profit margins suggest a strong competitive advantage.
Okay.
The ability to keep costs low while charging premium prices for essential services like domain name registration in VeriSign's case. This can be very attractive to an investor like Buffett, even if the ROIC isn't as dazzling by some measures.
So it seems like a combination of factors is at play here.
Yeah.
Potential undervaluation, high profit margins, and a dominant position in a critical market.
Right.
It's a reminder that looking beyond a single metric like ROIC can often reveal a more complete picture of a company's potential.
Absolutely. Financial analysis is about piecing together a puzzle.
Right.
Not just focusing on one piece.
Yeah.
We need to consider various metrics, understand the underlying business model, and assess the company's position within the broader economic landscape.
Speaking of the broader economic landscape, we were discussing some significant global trends earlier.
Yeah.
Europe's struggle with inflation.
Right.
And the surprising resurgence of China's junk bond market. Can we dive a little deeper into those?
Of course.
I'm still trying to grasp why these trends matter for the average investor.
Okay. Let's start with junk bonds.
Okay.
The term itself might sound alarming.
Yeah.
But it's essentially a bond issued by companies with lower credit ratings.
Got it.
They carry a higher risk of default.
Right.
But they also offer higher potential returns. Now, the fact that China's junk bond market is rebounding suggests that investors are becoming more comfortable with risk.
Interesting.
They're willing to lend money to these riskier companies, hoping for bigger payouts.
So does this increased risk appetite in China signal optimism about the global economy? Is it a sign that things are looking up?
It's certainly a data point to consider.
Okay.
Increased risk appetite often coincides with periods of economic growth. Investors feel more confident about the future and are willing to take on more risk to achieve higher returns.
Right.
However, it's important to remember that junk bonds are inherently volatile.
Yeah.
The market can shift quickly, and those higher potential returns come with higher potential losses.
That makes sense. It's a delicate balance between risk and reward.
It is.
Now, what about Europe's inflation woes?
Right.
How does that factor into the global economic equation?
Inflation in Europe is a concern for a couple of reasons.
Okay.
Firstly, it can erode purchasing power. If prices keep rising, consumers have less money to spend, which can slow down economic growth.
Right.
Secondly, it can lead to higher interest rates.
Yeah.
The European Central Bank might raise interest rates to try and curb inflation.
Okay.
Which can make it more expensive for businesses to borrow money and invest.
And how does this impact investors like us here in the U.S.?
It creates a ripple effect.
Okay.
As the European Central Bank raises interest rates, it can influence the Federal Reserve's decisions on interest rates here in the U.S.
I see.
Higher interest rates can affect everything from mortgage rates to the cost of borrowing for businesses.
Right.
Which can ultimately impact economic growth and stock market performance.
So even though these events might seem distant, they can have a real impact on our financial lives.
They can.
It's a reminder that we're all interconnected in this global economic web.
Exactly. And that's why it's essential to stay informed about what's happening. Yeah.
Not just in our own backyard, but around the world.
Okay, let's shift gears a bit.
All right.
And talk about some of the other headlines we have from Bloomberg and CNBC.
Okay.
Bloomberg reports that Deutsche Bank is turning bullish on European stocks.
Interesting.
While CNBC highlights Toyota's unexpected investment in rocket development.
Wow.
These seem like disparate events.
Yeah.
But are there any connections we can draw?
That's a great observation. At first glance, these headlines might seem unrelated.
Yeah.
But they both offer valuable insights into the current economic landscape.
Okay.
Deutsche Bank's bullishness on European stocks suggests a growing belief that the European market might outperform in the coming year.
Okay.
Despite the challenges we discussed earlier.
Yeah.
It suggests that some investors are seeing potential for growth and opportunity, perhaps betting that the European Central Bank will manage inflation effectively.
So there's a sense of cautious optimism.
Right.
Even amidst the inflation concerns.
Now, what about Toyota's move into rocket development?
Right.
What's driving that?
Toyota's venture into rocket development highlights a key trend we're seeing across industries.
Right.
Diversification.
Interesting.
Even established companies are looking beyond their traditional sectors for growth and innovation. The automotive industry is facing disruption from electric vehicles and autonomous driving technology.
Right.
So Toyota is strategically branching out into new areas like space exploration.
That's fascinating. So even a company known for its reliable cars is looking to the stars for future growth. It's a reminder that the business world is constantly evolving.
It is.
And companies need to adapt to survive and thrive.
Right.
But what about the other side of that coin? What does this mean for industries that might be disrupted by these changes?
That's a crucial question to consider.
Yeah.
If companies like Toyota, known for their cars, are looking beyond their traditional boundaries, what other industries might be ripe for disruption in the coming years?
It's exciting and a little daunting to think about.
It is.
We've covered a lot of ground here, from companies with impressive ROIC to global economic trends to potential industry disruptions.
Right.
It's like watching a real-time drama unfold with companies, investors, and entire economies as the main characters.
And as with any good drama, there are heroes, villains, twists and turns. It's never dull, that's for sure.
For sure.
But the more we understand the underlying forces at play, the better equipped we are to navigate the complexities and seize the opportunities that emerge.
Okay, so let's bring this back to our listeners.
Right.
We've covered a lot of ground, from ROIC superstars to European inflation to UK bond yields and even Toyota's rocket ambitions.
Yeah.
What does this all mean for the person listening right now?
Here's the takeaway.
Okay.
Even if you're not a Wall Street expert, understanding these trends can help you make more informed financial decisions.
Right.
Pay attention to ROIC when evaluating companies for investment. Keep an eye on global economic developments as they can impact everything from interest rates to investment opportunities. And don't be afraid to delve deeper into the financial jargon and ask questions.
It's all about being an informed investor.
Right.
And making choices that align with your financial goals.
Precisely. And remember, it's not about predicting the future with 100% certainty.
Yeah.
It's about recognizing patterns, assessing risks, and making decisions based on the best available information.
Well said. And that's where resources like this deep dive come in.
Right.
We try to distill the key information and provide context,
Yeah.
making it easier to understand the complex world of finance.
Exactly. We aim to help you connect the dots and see the bigger picture so you can make informed decisions about your financial future.
It feels like we're on the cusp of some major changes, and who knows what those changes will bring.
Right.
But that's also what makes following these financial trends so captivating.
It is.
It's like watching a real-time drama unfold.
Indeed. And as with any good drama, there are always those unexpected plot twists.
Yeah.
The more we understand the underlying forces at play,
right.
the better equipped we are to navigate the complexities and maybe even spot those opportunities as they emerge.
So to our listeners, we encourage you to keep those thinking caps on and stay engaged. The world of finance is full of surprises.
Absolutely.
Who knows what fascinating discoveries await us in the days and weeks to come.
And remember, we'll be here tomorrow morning with more headlines from major financial magazines, ready to help you decode the jargon and uncover those hidden meanings behind the numbers.
Until then, keep those thinking caps on. And thanks for joining us on this deep dive into the financial world.
See you all tomorrow morning with new headlines from major financial magazines.